In today's episode, we're talking about what to do when the stock market rises. I'll give you 3 tips for what you can do, action items you can take for when those prices are going up, and it's the companion video to my other video on what to do when the stock market dips. But first, if you want a channel that is going to help you speed up your journey to financial freedom through dividend growth investing, Stately Investing is the place for you. So hit that like button, hit that subscribe button, and turn on notifications, and let's get started. All right, everybody, welcome back to Stately Investing. So in today's episode, we're going to talk about what to do when the market rises. So for the past few weeks, my portfolio has been going up in stock price. So you can see some of the gains, especially in my Robinhood account where I was betting on some undervalued stocks and hoping that they would rise over the course of time. Well, they took off quicker than I expected, but obviously that's really along with the strategy for my dividend growth investing. And we really want to put this in context of what does it mean for dividend growth investors when share prices are going up, right? So I've done a companion video, which I will put up top and also link down below on what to do when the market dips. What's funny is that if you watch that video, you'll see that the advice is almost exactly the same, right? So we're going to go through it step by step. All right, so what do we do when the market rises? The first thing to do is pause and evaluate. This is tip number 1 from my previous video. And so what I mean when I say pause and evaluate is you want to take the time to look at what is going on with your portfolio. So share prices might be up overall in the market, but does that mean it's up overall for your portfolio, right? You don't have the entire market unless you're just in an index fund, an S&P index fund or a Dow Jones index fund, something like that, total stock market index fund, those type of things. Now, if you are in that situation, then you can just kind of track it, however the market flows. However, you want to really look at your individual portfolio and understand, what are my particular stocks doing? Are they trending up with the market, or are they counter to the market? Are they kind of flat? And really understand, that just because the market might be up overall doesn't necessarily mean that my portfolio is up. So once you've done that evaluation, you really should think about, okay, what does this mean for me? Do I stop buying stocks? Do I keep buying stocks? Do I potentially focus on one area or another? What you don't want to do is just react immediately. Remember, dividend growth investing is a long-term strategy. So you want to make sure that you're taking the time to evaluate your companies, making sure they're still solid, making sure that they still have, good financials and have a bright future ahead of them and can continue to pay their dividend and grow their dividend, right? That's what we're particularly focused on in this channel. So once you've done that pause and evaluated your particular portfolio, you can move on to step number 2, which is buy what is undervalued, dollar cost averaging. So again, this bullet point is identical to what number 2 was in the previous video. And so what do I mean when I say buy what is undervalued or dollar cost averaging? So there'll still be things in the market that are undervalued. And let's say every stock in your portfolio went up. So let's say you had 10 stocks in your portfolio and all 10 of them went up because of some great news in the general population or the general market, or just, all of those sectors seem to be going up. What I would encourage you to do is there's still probably some undervaluation on particular stocks within your portfolio. So even if everything is up, that doesn't mean that something is not undervalued. Potentially you need to go back further in history to see what price, these stocks were at previously. So, I can give an example where I purchased Store Capital, right? And you guys have hopefully seen my videos on Store Capital, my favorite stock. I'll put a link up top for you guys to check that out. But Store Capital, I was purchasing at $15 and $18, right? And now, we're up to, as of November of this year, we're up to $32, $32 for Store Capital. Great, right? My value is almost doubled since what I was purchasing in the $15 to $18 range, and that's amazing. But if I look back at Store's history, you can actually see where their price was actually higher than what it is now, right? And so kind of at their peak, and this is not that long ago, right? This is less than a year ago. You can see that they were, at $40, $50. So in that example, you want to understand that even though something might be rising, doesn't mean that it's at its peak. And it doesn't mean that it's above what it was previously. And if that level of pricing was supported for a long time previously, then that means there's a good chance that it will continue to get back up to that level. And so what that means is it's potentially still undervalued and something that I would want to consider buying. And so if you have the funds, I would consider to keep buying what is undervalued and making sure you're doing that kind of financial and technical analysis as necessary to figure out what those stocks are. So once you've done the first two steps, remember, pause and evaluate, and then buy what is undervalued, you want to really continue your regular investment schedules, which is tip number 3. Again, this tip is identical to what I said when the market drops. So what I mean by continue your regular investments, hopefully all of you dividend growth investors out there are following this advice, but what you want is your money to always be flowing into the market. So whether that's $5 every week or whether that's $10,000 every week, right? Whatever your budget is, make sure that you have some kind of schedule set up where money is directly taken from your account, one of your cash accounts, and is deposited into one of your investment accounts, and let that investing be kind of automatic. And that can be into an index fund, that can be in individual stocks, whatever you feel most comfortable with, whatever your strategy is. But just make sure that it's a habit. You want to make sure investing is habitual and that it's occurring at regular intervals. For me, I do this weekly, right? So every week I deposit $250 into my M1 passive income account, and it allocates appropriately, right? So if certain allocations are low, certain stock prices are low that week, then M1 knows to buy those stocks because it's under allocated in my targets for my portfolio. But what I'm saying is that you want to make sure these investments happen on a regular basis and that you don't have to think about it, because whether the stock market goes up or down really doesn't matter for your dividend growth investing in the long term. You know that the market is going to rise over the long period of time, and you should be making regular investments and have those on a schedule so you don't have to think about it, because you shouldn't have to make a decision whether the market is going up or down. You just need to make sure that you're investing on a regular basis. So lastly, the strategy all assumes that you've done your research for your initial investments and that you have high quality stocks or funds. So this is key, right? So none of this is important. Like none of these 3 steps will help you out unless you've already done the research for your initial investments, and that you really are evaluating the basics, right? So it kind of goes back to step 1, but you should have done this before you even consider whether the market is going up or down. I encourage you to always take time to understand what you're investing in and make sure that you fully understand the stock's business model, and also their financial situation. So there are plenty of guides out there on how to do this. You can watch some of my previous videos on how I do this and how I evaluate my portfolio at regular occasions. But overall, these 3 steps, so pause and evaluate, buy what's undervalued, and continue your regular investment schedules, is identical to what I said when the market lowers, right? So you're like, hey, Burnett, this is an easy video for you to make, right? It's the same advice. Well, there are slight nuances, right? There are slight differences because the advice is good no matter what the market is doing, right? You should be doing this no matter what, obviously, but the context is a little different whether the market is up or down. And so you really want to make sure that you are analyzing carefully and understanding which portions of your portfolio are doing what and how to adjust. So if you guys like this video and got something out of it, feel free to give it a thumbs up. Feel free to subscribe if you want to. Leave a comment below. I'd love to know what some other advice is you guys have out there for what to do when the market rises or what to do when the market dips. I appreciate all of the feedback out there, and I will see you guys again next week.